Investing can often feel complex and overwhelming. Many beginners believe they need to navigate a maze of financial products. They think success requires picking winning stocks, timing the market perfectly. However, there is a much simpler, more reliable path. This essay will explore a single investment fund that has gained immense popularity among long-term investors in Europe. We will discuss the Vanguard FTSE All-World UCITS ETF, commonly known by its ticker symbol VWCE. Our goal is to explain, using simple facts and clear examples, why this one fund can potentially form the entire foundation of a successful investment portfolio for many people. We will maintain a calm and factual tone throughout this discussion. This essay is designed for those who are just starting their investment journey. It is for anyone who wants a straightforward, low-maintenance approach to building wealth over the long term. You will see how a consistent savings plan combined with a globally diversified fund can lead to substantial growth over decades. We will not use hype or make grand promises of getting rich quick. Instead, we will rely on numbers and logic to show a sensible path forward. By owning a small piece of thousands of companies across the world, you participate in global economic growth. This strategy is not about finding a needle in a haystack, it is about buying the entire haystack. We will show you precisely how this works in practice, from the companies you will own to the costs you will pay. By the end, you will understand whether this simple one-fund approach aligns with your goals, helping you cut through the noise and focus on what truly matters for long-term success. At its heart, VWCE is an exchange-traded fund, or ETF. Think of it as a large basket that holds shares of many different companies. When you buy one share of VWCE, you are actually buying a tiny slice of all the companies inside that basket. The specific basket that VWCE holds is based on the FTSE All-World Index. This index represents large and mid-sized companies from developed and emerging markets. It provides a broad snapshot of the global stock market, an incredibly diversified collection of businesses. Let's look at the numbers. VWCE holds shares in approximately 3,600 different companies. These companies are located in dozens of countries: United States, Japan, Germany, China. Because the index is market cap weighted, larger companies make up a bigger portion of the fund. Around 60% of the fund is allocated to companies based in the United States: Apple, Microsoft, Amazon, and other global leaders. The cost of owning the fund is crucial. VWCE has a total expense ratio of just 0.22% per year. This fee covers operating costs and is deducted automatically from your investment's value. A fee of 0.22% is very low, especially compared to actively managed funds. A single share typically trades for around €130 on European exchanges. VWCE is an accumulating fund. Dividends are not paid out. Vanguard automatically reinvests them, harnessing compounding over time. For long-term growth investors who do not need income now, this is a simple, efficient way to boost growth without extra effort. Fees may seem like a minor detail in the grand scheme of investing. When you see a fee of 0.22% or even 1.5%, it can be hard to grasp the consequence. However, over a long horizon, the gap between low and high fees can be monumental. Costs reduce returns year after year, and their effect compounds. A higher fee is a constant drag, slowly eating away at potential wealth. Think of it like filling a bucket with a leak. A small leak still lets you fill it. A big leak can prevent you from reaching your goal. Investment fees are that leak. VWCE's 0.22% is a very small leak. A 1.5% active fund is a much larger one. Both are filled by market returns, but one ends up much fuller. Fees are one of the few things you can control. Market performance is uncertain. Fees are not. Let's compare. Two investors start with €10,000 and both earn 7% before fees. With VWCE at 0.22%, the net growth rate is 6.78%. After 30 years, that grows to about €74,000. With a 1.5% active fee, net growth is 5.5%. After 30 years, it is only about €52,000. The difference is a staggering €22,000, wealth transferred to fees. Choosing lower costs improves long-term outcomes without extra risk. That is why passive investors obsess over minimizing costs. Let's transform these abstract concepts into a relatable, real-life scenario. Meet Maria, a 25-year-old living in Europe who has just started her career. She wants to invest for retirement but feels intimidated and does not want to research individual stocks. After research, she chooses a simple, disciplined strategy, a single, globally diversified, low-cost ETF. She chooses VWCE because it aligns with her long-term hands-off approach. Maria sets up an automatic plan to invest €300 every month. This is dollar cost averaging, in her case, euro cost averaging, buying more shares when prices are low and fewer when prices are high. She avoids timing the market, ignores daily noise, and focuses on the plan. By owning a piece of over 3,600 businesses across sectors and countries, she is not betting on any single company, sector, or country, but on global progress. Her one ETF portfolio is easy to understand, simple to implement, and incredibly efficient. She focuses on what she can control, her savings rate and her consistency. Now, let's fast forward. She invests €300 every month from age 25 to 60, so up to 35 years. A total contributions, €126,000, using a hypothetical 7% average annual return. Her portfolio could grow to around €370,000. That is approximately €244,000 in growth, the magic of compounding. She achieved this without picking stocks or predicting markets, just consistency, time, and low costs. While a 100% equity portfolio built with VWCE is powerful, it is not a universal solution. If you are over 50 and plan to retire within 10 to 15 years, an all-stock allocation may be too aggressive. A major downturn just before retirement could be devastating, with little time to recover. A more balanced approach is generally recommended, including less volatile assets like bonds and some cash. Gradually reduce equity exposure and increase bonds as retirement nears to help preserve capital. If you need a regular income today, VWCE may not be ideal. VWCE reinvest dividends. You will not receive cash payouts. A distributing alternative is VWRL, which typically pays dividends quarterly, providing cash flow. If you want granular control, overweighting a sector or a country, VWCE's market cap weighting will feel restrictive. Hands-on investors may prefer multiple specialized ETFs or even individual stocks to express specific views. VWCE is listed on major European exchanges such as Xetra, Borsa Italiana, and Euronext Amsterdam. The ticker is VWCE and the price is quoted in euros. You can buy through most brokers. Prices move intraday as the thousands of underlying stocks move. Taxes vary by country. Capital gains and, in some places, taxes on reinvested dividends. Understand local rules or consult a tax advisor. There is currency exposure. You invest in euros, but many holdings are in other currencies, notably the US dollar. We explored using a single fund, the Vanguard FTSE All-World UCITS ETF, VWCE, as the core of a long-term portfolio. VWCE offers ownership in over 3,600 companies across the globe. Its very low annual cost of 0.22% is one of its most powerful features. Minimizing fees can add tens of thousands of euros to your final wealth over an investing lifetime. High fees are a drag. Choosing low costs is a win from day one. Maria's disciplined plan showed how $126,000 of savings could become about $370,000 over 35 years at 7%. Her success relied on time, consistency, and low fees, not complexity. But this approach is not right for everyone. Too risky near retirement, unsuitable if you need income, and restrictive if you want custom tilts. For income, consider a distributing fund like VWRL. Understand your personal financial situation, time horizon, goals and risk tolerance. If this approach resonates, continue learning. Read the fund's official documents and research your country's tax rules. Honestly assess your goals and risk tolerance. A calm plan, a simple plan, a well-understood plan is your greatest ally on the journey to financial well-being. To continue learning about sensible, evidence-based investing, consider subscribing for more content.